Advanced Financial Accounting. In this presentation, we'll take a look at an example problem calculating the fair value method. Get ready to account with Advanced Financial Accounting. We've got our information on the left side. We're going to be recording this journal entry by journal entry, entering the transactions related to one company having an interest in another company. So P having an interest in S, we will be using a fair value method in order to do so. In other words, we have one company that's purchasing an interest, an equity interest stock purchasing interest has a 30% interest in another company, P being the purchaser, S being the purchasee company in this case. Now you might be saying, hey, look, there's a 30% interest. That's over like the standard rule of 20%, and therefore we should be using the equity method. Note here, we're going to be using the fair value method, and there are exceptions to the rule. So there's the reason we want to use a fair value method is because we want to be able to compare this to the next problem, where we'll take a look at the calculation, which will have the same numbers, but with a separate method. So we can compare and contrast the two methods using the same number. And also note that if there's a 30% interest, if you're over the 20%, there's a general rule that you have an influential interest, but it's not a definite rule. For example, if someone else owned 51%, they have a controlling interest, and now your 30% doesn't look as influential as it would otherwise. So in any case, we are going to use the 30% that is over the 20% general rule, where we would normally not use the fair value method, but the equity method. But for those two reasons, we will be using the 30% here. So we can apply that out. And then we're going to say on January 2000 X7, there was a purchase from P to S of the AT1000. And then we're going to have S's information down below. We got the net income, we got the dividends, and then we have the fair value down below. We will be recording the transaction by transaction down here, one by one. We'll be doing this for the 3-year time period. So we'll actually go through 2000 X7, then we'll close out the books and we'll concentrate on 2000 X8 and then 2000 X9. Now, obviously, we're going to be posting this to a very simplified trial balance. Why? Because I want to see something that at least is in balance, so you get an idea of how this looks in terms of assets, liabilities, equities, income, and expense, and how it would roll through with actual journal entries from year to year. So first of all, we're going to say there's a purchase. There's a purchase. P company purchased the common stock, purchased an interest in S, which accounts for 30% of the interest. So they have a 30% basically voting power over S, which is normally influential, but here we're saying not so, and therefore using the fair value method. Now, the first journal entry, straightforward. Investment in S is going to go up. Cash is going to go down. So we're paying cash. Cash is going to decrease. We're going to put the investment in S as an asset account. So we would say cash is going down over here. If we post this out, we're just posting this journal entry. So cash is going to go down, and then we now have the investment on the books. Everything else pulls forward. So we're just concentrated on these items over here. This will be the same whether we use the equity method or the fair value method, and that makes sense because you would think if this is an arm's length transaction, a market transaction, then whatever we paid, the consideration given for the stock would then be the fair value because it is a market type of transaction. Therefore, the starting point will be the same whether using the fair value method or the equity method. Now we'll take a look at the next transaction that's going to be happening. We're looking at 2000 X7 now. So in 2000 X7, we're going to have an increase to cash and the dividends that are going to be recorded. In other words, we have the dividends of the 14,000 that are issued by S company. Our portion of those dividends will be 30%. So if we were to pull up the trusty calculator here, we're going to say, all right, they issued 14,000 of dividends times 0.3, 30%. We got 4,200 of them. That means we're going to get cash. Now, note some problems might put the dividend in here as receivable, a dividend receivable, because they declare the dividend and haven't issued it yet. But eventually, you're going to get the cash. So I think it's easier and clearer to see. You're saying, okay, S now paid the owners of the company, the stockholders, dividends of cash. We are a stockholder as P. We own 30%. Therefore, if they had total dividends of the 14,000 that were distributed, we will then get cash, increasing cash of the 4,200. Where does the credit go? The credit, and this is what's different under the fair value and equity method, will go to dividend income here. So we're going to say, all right, cash is going up now. If we post this out, cash is going up, and then the other side is going to dividend. Now I'm posting a credit here that's income, not like a negative income. So now we have income going up by that 4,200. It's going to be the dividend income. Why is that different than the equity method? Because in the equity method, we would be using the net income. We would say, hey, their interest, S's interest, went up by 43,000. And if we own 30%, if we were to say that 30% was influential, then we would say, hey, I should be recording my 30% of that 43,000. Why? Because I have significant influence over them and I could make them, or at least put significant pressure on them to pay me the dividend. But if I don't have significant influence, then that money is not really mine. I don't have much control over it until they actually give it to me. So if I had control over it, then you would think you'd record the income here when they earn it. But if you don't have control, then maybe when they wait for it, you record the income. Right now we're waiting till we actually get paid. Also note, when you think about the dividends, this dividend amount down here, you can think of it as, if they made net income in the year of 43,000, then they could pay out the whole 43,000. Usually you think about the dividend as basically coming out of the earnings that they have made. Now, it could have come out of the current year earnings. It could have came out of earnings in the prior year too, retained earnings. But typically that's the idea. We're saying, okay, they earned $43,000, and then of that $43,000 in 2007, X7, they gave out $14,000 to the owners as a distribution. Okay, so instead of us recording our 30% share of the income, we're just going to record the 30% share of the income when we actually get it. Therefore, revenue goes up by our portion, 30% of the 4,200, net income increasing by that amount. Next transaction we're going to have then, this is going to be reliant on basically what we're going to get from our broker. So we can imagine now getting our broker statements, just like a normal investor at the end of the year, saying, hey, this is your stocks that you have invested and whatnot, and here's the information related to it. And they're going to say, hey, and we're going to imagine now at the end of the year, at the reporting time period, the broker says that there's a fair value, because these stocks are traded on the stock exchange, we're imagining here, of 101,000. So we know what the fair value is, and because these are things that are traded, these are things that it makes sense for us to fair value, other than which is different than if we had like a building or something, which is very difficult to fair value given its unique nature, and that there's not transactions that are transacting all the time with a building exactly like ours. Here there are. So we can say, okay, I'm going to depend on the market then. I'm going to depend on the market actually trading stocks that are equivalent to mine, and say, okay, well, my stock is currently on the books at 81,000, and it's now worth 101,000. So good purchase here. Buy low, sell high. That's my motto. We did good job. So then 101 minus what we have it on the books for, 81,000, is going to be the 20,000 increase. So that's what you would typically do. You're going to look at your books and say, well, on my books, it has 81,000, and my stockbroker statement there says the market value is at 101. I need to make this number 101. How am I going to do that? I'm going to increase it by the 20. So there it is. We increase the investment by the 20,000. And then the question, of course, is, well, where does the other side go then? I got to put the other side somewhere, and I didn't really realize the gain. This is where the tricky part is, because normally we don't recognize the gain until we realize it, but we're going to put it in this case to unrealized gain. So we're going to put it on the income statement here, and the other option is kind of put it into the equity section to have unrealized gain, but then your equity section becomes a mess, right? Because you got a bunch of stuff in it. But anyway, we're going to record it on the income statement of the unrealized gain of the 20,000. So we're actually recording the gain based on the market activity, what the market says our portion of the stock is worth. Okay. Now we're going to go to the next year, to 2000X8. When we do so, we're going to take these ending numbers. We're going to make them now our beginning numbers in the next year. We're going to roll out the 4,200 and the 20,000 into retained earnings. So now we have our beginning numbers, cash, investment, retained earnings, now being equivalent to everything we had before. Nothing's now in the income accounts. We're only going to be focusing in on income accounts related to our item we're focusing in on here, the investment that we have. So we're not going to have another purchase. That's going to be different, obviously, from the first year from what we have now. Now we're just going to be focusing in on what happens. There's no purchase that took place, but the other two journal entries are the same. First, we had dividends. How many dividends were now issued in year 2, 2000X8? It says 29,000. So we're going to take our 30% of that 29,000, which of course is going to be the 8,700, which if we pull out the trusty calculator, 38,000 times 0.3. Actually, 38,000 is the wrong number. We're taking the dividends. 29,000 times 0.3. That's going to be that 8,700. So same transaction. We're going to say cash is going to go up. So we're getting dividends, meaning the investment that we're investing in, S company, issued dividends out to all of its stockholders, of which we own 30%. So they issued out the 29,000. We're going to get cash, 8,700 from them. We're assuming cash dividends here. The other side then going to the dividend income. So this is what's different than the fair value method. We're not recording the 38,000, our portion of their equity. We are reporting our portion of the cash they actually paid out to us when they paid it to us. So cash is then going up. Then we have our income going up. So there's our first transaction. We're recording the income for it. Then at the end of the year, we're going to say, all right, how much is this thing worth now? We're going to get our investment statement. We're going to say, hey, look, it's on the books. We have it on the books at 101,000. According to our broker, according to the statement that we have, which has the market value on it at this point in time, this is what you do in practice. You'd say, okay, here it is on my books right now. It's at 101,000, 101,000 minus what now they say my broker statement says, 98,000. And you're going to go, okay, well, I trust the market, right? I should tie this out to the market. So I need to bring this 101 down to the 98, which my broker statement says. Okay, so we're going to say, all right, that means that we're going to have to credit it by the 3,000. Where's the other side going to go? Well, we're going to record an unrealized loss. So we're going to say, all right, same transaction, except this time it went down. The other side goes into the unrealized loss. We have a loss here, this being a debit, bringing down the net. So the net activity, it went up by the dividends we got, 5,700 income. And then we had this loss that we recorded by the value of the stock going down by the 3,000. Now, again, note that these are income statement accounts down here. So you might say, well, where's the dividend and the unrealized gain or loss that we had before? It rolled up to the retained earnings. It's in the retained earnings right now. And then we're going to do this again. These numbers we're going to roll in. We're going to do the closing process. So we're going to start now for 2000X9, year 3, roll this out into the retained earnings, and then we'll do this process again for 2000X9. So now we're at cash, investments. We got the retained earnings. Nothing's in the income accounts. They've been cleared out. And so now we're in 2000X9, same process. We don't have the purchase taking place. Other two transactions, pretty much the same. What's the dividends we got? We got 30% of the dividends of the 19,000. So 19,000 that was issued in 2000X9, 30%, 5,700. There's the debit, there's the credit. We're going to get cash going up. The other side's going to be going to that income account as well. So there's our increase in the income for the third time period. And then the next item that's going to happen, end of the year, we got our broker statement. We got the good old broker statement. And we're going to say, all right, what's the market tell me now? What is this thing trading for at this point in time? Because my shares are exactly equal to the other shares. They tell me what the market price is. This is what I have on the books. I've got on the books 98,000. They're telling me now minus it's worth 108,000. Great, it went up 108,000. I need to make my number 108,000. So I'm going to subtract it and say that's another $10,000. I got to increase my account by the 10,000 to bring it up to what the market says it should be at this point. So there it is, increasing the investment by the 10,000. The other side's going to go now to a gain again. Notice what the market's doing. It's flip-flopping back and forth. That's what markets do. We're dependent on the stock market to tell us. But that's an arm's length transaction. So you would think that would be a good indicator. And it's just the same as our stock, so pretty good indicator. So okay, now we're back up to 108,000. And then we have now an unrealized gain of 10,000. So now we have the total gain representing the dividends that are given to us and the 10,000 increase for a total gain this time of the 15,700 for year 3. So you can see how that process is working. Now, when we move to the equity method, we're going to do the same problem next time with the equity method. And in that case, we're not going to be depending on the market down here. So for the equity method, we're just going to ignore the market, the swings of the markets, we're going to ignore. We're not going to depend on the market to tell us what it is, even though it's not, the market for this type of asset is pretty good because it's actually, again, there's actually transactions taking place that are the same thing, exact thing that we're selling, which is not the same as if we were to take transactions related to a building. It's much more difficult to do the fair market thing with a building, because a building is unique by its nature. It is unique. So what we'll do instead then is we're going to say, hey, we have an equity interest. So if their equity is going up in the 43,000, and we know we have 30%, and we have influence, we could force them to pay us that in the form of dividends or have significant influence in order to do so, then we should be recognizing our 40% of their equity increase. Net income is the equity increase. The equity portion of their balance sheet has gone up in part due to the net income. And so we would represent our 30% of that instead of depending on basically the market to tell us what our valuation is, and instead of waiting until we actually get the dividend to record that income.